Did you know that nearly 70% of new investors lose money in their first year? You don't want to be part of that statistic, do you? Today, we're exploring the 5 investment mistakes that new investors often make. Stay tuned until the end. I promise there's a game-changing insight waiting for you. Let's kick things off with mistake number 1, lack of research. Many new investors dive headfirst into the market, lured by the shiny promises of quick gains. But here's the kicker. Investing without research is like jumping into a swimming pool without checking if there's water. Imagine investing your hard-earned cash into a stock because your friend raved about it over dinner. That excitement can quickly turn to despair when you realize the company is struggling. Take the time to research. Read up on companies, analyze trends, and understand the market. You wouldn't buy a car without a test drive, right? Treat your investments the same way. Because unless you enjoy taking financial risks like it's a roller coaster ride, research is your safety belt. Moving on to mistake number 2, chasing trends. We've all seen the headlines. This stock is soaring. Get in now. But chasing trends can lead to disaster. Investing should be a calculated strategy, not a frantic sprint to catch the latest hype train. Picture this. You jump on the bandwagon, and the next thing you know, the stock takes a nosedive. You're left holding a losing investment, while your friends who did their homework are reaping the rewards. Remember, just because everyone else is jumping doesn't mean you should. Let's be real. FOMO is not a valid investment strategy. You don't want to be that person who bought Bitcoin at its peak and now has to explain it at every family gathering. And now, mistake number 3, overlooking diversification. Many new investors think they can hit it big with 1 or 2 stocks, but that's like putting all your eggs in one basket. And we all know how that story ends. When the market gets rocky, a lack of diversification can wipe out your entire portfolio. Instead, spread your investments across different asset classes, stocks, bonds, and maybe even some real estate. This way, when one sector struggles, another can help keep you afloat. Think of it this way. Don't put all your snacks in one bag. It's much better to have a buffet than a single sad sandwich. Now let's dive into mistake number 4. Trying to time the market. Many new investors think they can predict market highs and lows, like there's some kind of financial Nostradamus. Spoiler alert, it's a losing game. The market is unpredictable, and trying to time it can lead to missed opportunities and substantial losses. Instead of obsessing over when to buy or sell, focus on your long-term investment strategy. Remember, it's not about timing the market. It's about time in the market. If you had $1 for every time someone tried to time the market and failed, you'd probably have enough to retire early.